Joining us now to look at the markets and read the charts is Katie Stockton, Fairlead Strategies founder and managing partner and a CNBC contributor. Katie, good morning.
Good morning.
So set the scene for us. We got a little bit of a breakout in the market last week. The S&P 500 gets above, 4,600, back to March 2022 levels. Is this decisive? What do we think about this? Because the market had really been going sideways for weeks before this.
You know, the level we're actually watching is 45.95. We've been rounding up. So with the close about 10 points above that last Friday, we have our first weekly close above. We, as you probably remember, always wait for two decisive closes above a resistance level to call it a breakout. So it's not decisive yet. And we do have indications that we could see some consolidation or more consolidation really this week from more of a macro perspective. We're looking for yields to bounce a little bit. We're looking for the dollar to bounce, especially against the yen. And that would be very natural, normal price action for equities as well if they did consolidate. So not convinced we'll get that breakout necessarily here this week, but we do ultimately think there's a very good chance of it and that it would be a bullish long-term development.
We were talking about yields and how they kind of went down almost 1 percentage point in 10 years and down to 4.1 and just sort of felt like they were overdone maybe and now we're lifting a bit. We do have these auctions coming up. So what's a critical point to look at in terms of where the yield should go and whether that becomes a challenge to stocks?
Yields have already broken a couple of tiers of support in our work. So the next level for the 10-year is about 393. That's based on a Fibonacci retracement. And the upside resistance is closer to 455. So there's a pretty wide spread between support and resistance. The bias, though, is really lower from an intermediate term perspective, and we have downside momentum across that time frame. And as we've discussed here in the past, we have some signs that it's going to be a lasting corrective phase for yields. This is on the monthly bar charts. We have some countering indications. We know that we've been in this Treasury bear market cycle for some time. This suggests that this is a counter trend move within that scope.
Counter trend move. So in other words, yields would have this downward bias, but as a kind of a counter to the longer term trend.
That's exactly right.
And in terms of if we do get a further pullback in stocks, some more consolidation to the downside, a lot of times first half of December sometimes is choppy. What would be normal in terms of how low we would go? And you would just look at that and say, yep, that's just routine.
Well, the 50-day moving average is always a very easy gauge of initial support. So we feel like that's something to watch perhaps, but we don't feel like a significant pullback even to the 50-day moving average seems to be in the cards for the market. And it's just simply based on our short-term momentum gauges, which have wavered a little bit, but that's natural after some strong gains that we saw in November. So we see this as really a healthy consolidation. We'd also love to see the VIX get below that support that it's testing. It's around 1270, and that would be another bullish indication for equities. So we're looking for more consolidation versus an actual pullback.
And I'm just looking, so the 50-day is like just under 4,400 in the S&P at the moment or so?
That's right. So in a way, it would be somewhat significant, right, on the downside. So with that being initial support, we did actually move to a neutral short-term bias last week just because of that spread, again, resistance being so close by. But we feel like we're going to probably just be there temporarily. If we see the S&P 500 falter here and unable to confirm that breakout and then it shows up in the intermediate term gauges, well, unfortunately, that means we're going to have to kind of flip back to more of a bearish short-term bias.
And then there has been a bunch of internal rotation in the last few weeks. You've seen the average stock outperform the mega caps to some degree. Banks have done well. Small caps have improved. Is that something that seems like it's a real leadership change or just kind of, trimming around the edges along the way?
I think you hit on it with the banks. We did upgrade financials last week to overweight, and this is for a long time we had not been overweight, really just sat at equal weight for some time. And it's simply because the ratios, looking at things like XLF, the financial spider versus the S&P 500, had come out of what appear to be basing phases. So this is an intermediate term bias that we're asserting here, but the banks do show some promise. These are counter trend signals that we have, so it's a little higher risk to express a view there, but we do feel like there's real potential. And with financials having such a huge footprint in the S&P 500, if they participate and lead even on the upside, well, that's what could get the market out of this big, wide, long-term trading range.